I guess we are set. Hello everyone, my name is Jarek Buchholz. I'm founder of Canada Real Estate Investing Club, and I would like to welcome today very powerful speakers, and thank you very much for showing up. I would like to introduce Madeleine. That's Italian name. How you pronounce it, Madeleine?
It's focaccia, yeah, focaccia, like the bread, like the bread.
Okay, so Madeleine, would you mind, what kind of speakers did you bring to us today?
Well, hi everybody. My name is Madeleine Focaccia of the VIA Group, and thank you for the introduction, Jarek. Much appreciated. I've been investing in the U.S. now for about a year. We started with purchasing REO bank-owned bulk foreclosure packages of houses, of which we're currently renovating and putting tenants in to sell as turnkey investments to Canadians. And after much research, we're also concentrating our efforts in multifamily projects in Texas with joint venture partners in Canada. I work with 5 partners in the U.S. who are located in several areas of the country. During our expansion into this market, I found that it was critical to have great advice with respect to accounting and legal, not only for ourselves but also to the benefit of our Canadian investing partners. So I've been working with George Dube of Dube and Associates for about 4 years now. I have 10 corporations in Alberta, of which he oversees all of them for me as my accountant. George is a veteran real estate accountant and investor. His practice focuses on providing the knowledge and tools clients need to increase and preserve the value of their business. He's a frequent guest speaker at an assortment of meetings, events, and workshops throughout the year. There, he addresses a variety of tax and accounting topics with implications for real estate investors with a particular focus mostly on tax strategies. So in addition to his speaking, George has also written and contributed to many national and regional publications. His writings include 2 books in which he co-authored, one being 81 Financial and Tax Tips for the Canadian Real Estate Investor, and the second, Legal Tax and Accounting Strategies for the Canadian Real Estate Investor. And he's also co-developed the Accountant in a Box program. More recently, Peter Cuttini has joined Dube and Associates as their U.S. accounting specialist, and upon receiving his chartered accountant designation, Peter was employed as tax manager in the real estate department of a national accounting firm. He joined a mid-sized regional firm as a partner for a number of years, where he received his U.S. Certified Professional Accounting designation. And he also completed the Canadian Institute of Chartered Accountants 2-year in-depth taxation course. So as a U.S. CPA, Peter has provided significant knowledge and experience to his clients who are working, doing business, or investing in the U.S. He's advised his clients on a variety of structures that have minimized their tax and legal liability in the U.S. and Canada. He also works with numerous lawyers who are expertise in cross-border transactions. And he also has given a number of presentations on cross-border real estate investing, and he's begun writing articles for national real estate magazines. He's currently expanding his real estate portfolio with George in Canada and the U.S. So in working really closely during our expansion, I cannot say enough about the quality of the advice that I get from these guys and how lucky we are to have them here with us today. So thanks so much for coming on the webinar, George and Peter, and I'll let you guys take it from here.
Thank you, Madeleine. It's usually hard to come and jump onto a conversation like that when you're introduced in such a fashion, so we'll keep this part pretty brief here for Peter and I. But what we wanted to talk tonight about was just going through again, some pros and cons for those that are considering or already investing into the United States. So we're going to talk a little bit about the structure, some of the liability issues, and an assortment of different taxes that as Canadians now we perhaps at one point in time we're not as concerned about, but now we have both sides of the border to play with, and to the detriment of many, it can be something that is not given enough attention to. And so what we would as well welcome from the group is to field questions as we're going along. Peter's going to end up doing a little bit more of the talking, and I'm going to spur on some questions. And a lot of these will as well come from our own experiences and looking in the United States and those that we typically receive from clients when we're providing consultations to them. And so in some ways, we're going to go through almost a mini consultation, if you will, where perhaps I'm the person looking to Peter for advice and trying to determine how should I be structuring my affairs as I go into the United States.
Okay.
Thanks, George. This is Peter here. We always tell our clients when investing in the U.S., there is no one solution. Each person's situation is going to be different than the next. Anyone who has a cookie-cutter solution is doing a disservice. I think you pretty much have to judge your own situation and then develop a plan around that. Things to consider when investing in the U.S. or deciding on the structure. Age of the investors. An investor who is 35 is going to be want different things than someone who is 65. Number of investors. Is this just a husband and wife? Is this an individual? Is this 4, 5, 6 friends getting together? Definitely changes potential structure. Income level of the investors. Someone who has multi-millions of dollars of income, it would be nice for all of us to be like that, is going to be different than someone who has a regular day job and they're just looking to enhance their retirement portfolio through investments in the United States. Expected future appreciation of the property. If we're expecting the property to stay ho-hum, go up by inflation, will be very different than if we're expecting double-digit or significantly greater appreciation of the property. Risk tolerance of the investor. Some guys are more and gals are more riskier and are willing to take greater risk. Some people like the conservatism. George and I are relatively conservative in our own investments, and we move forward from there. Value of the property. Purchasing a $30,000, $40,000 single-family home in the United States will have a vastly different structure than purchasing a multi-million-dollar apartment building. They're totally two different recommendations and strategies. Sources of the funds of the down payment. Is the funds coming personally? Are you borrowing the money? Is it corporate funds? That will affect what structure we would recommend. And last but not least, family situation. Are there age of majority children to come into play? Is there a potential of a divorce, or is that an issue that people want to worry about? There's all those type of family issues that have to come into play.
And Peter, now, I've heard a lot, and we get a lot of questions from clients in terms of, will things such as when I want to sell the property affect me? Does my financial position today affect me? And what if one of my family is not necessarily in as great of health or myself?
Health is always an issue. The U.S., and we'll touch on this later, has a fairly arduous estate tax, which is a tax on the value of your estate at death. We really don't have this here in Canada. In the U.S., it can be as high as 35% of the total value of your assets. Do those other factors come into play? Absolutely. Again, every situation is unique, and you have to look at the entire situation.
Okay. So overall, there's a lot of factors anyway that have to be considered, so there's not going to be a boilerplate solution for one and all. So tax and legal factors that we're going to, again, try and break down a little bit through this presentation, starting off with a little bit on the legal side of things, keeping in mind that we're not lawyers, but we're just going to touch on some very general points there. Withholding taxes, income taxes, capital gains tax, and lastly, estate tax issues, which Peter just touched upon. In terms of the legal liability, needless to say, the United States is a little bit more reputationally litigious than Canada and many other countries. So on the personal ownership side, the majority opinions tend to be that we're more exposed to legal liability, where ownership is through an individual. The corporate ownership is often looked towards for a little bit of that protection, and in the United States there are different vehicles that are also available to help on that side.
So normally, when you have rental income in the United States to a non-resident, on a monthly basis, the tenant or property manager is supposed to remit 30% of the gross rental income to the United States Treasury Department. Now, 30% of gross rental income is a significant number, and I do not have any clients who actually do this. What happens is you elect to make the income effectively connected with the United States. An effectively connected income is taxed at the graduated income tax rate on the net income, not on the gross rental income. This election is made on your first annual tax return, and basically what it says is, hey, we're going to file the income on a U.S. tax return as if we were earning it as U.S. citizens.
Peter, can you explain to us what a graduated income tax rate is?
So a graduated income tax rate, for example, in the United States, their personal income tax rates vary on the first 10,000 up to 300,000. There's different rates for different income in that income levels. Just like in Canada, where we have our different tax brackets, they also in the United States have their different tax brackets.
Okay. But what happens if we don't let the IRS know that we're here, we'd like to file and do something, be taxed on our net income instead of our gross income?
If the IRS were to find out about this, what they will do is they will not allow you to go back, or they potentially cannot allow you to go back and file as if it was on the net income basis. So they can technically say, too bad, we want 30% of all your gross rental income, and that's it. That's your tax that you have to pay.
So needless to say, for all the listeners here, that is an extremely expensive proposition, and we have had experience where we've seen actually some of the foreign investors into Canada, when Canada does have a similar rule, are affected in quite the same fashion. So it's not something to ignore. It's not something to say, I'll worry about it in a few years. There's not much income there. By the time I'm done paying my property taxes, utilities, there's hardly anything left over. That may be true, but obviously we don't want to be taxed on our gross income as compared to the net income. And Peter, maybe you could as well comment on, certainly there's many stories of people not filing these tax returns, not worrying about it. How would the IRS ever catch me?
Two areas potentially where we've seen the IRS come into play. One would be when you go to sell the property. The IRS is looking at the transaction, does an audit on the sale, and says, did you have any rental income previously on this property? And if you say yes, they'll ask, where were the tax returns? Well, I never filed. Okay, please remit 30% of all your gross rental income on a go-forward basis, on a previous basis. The second area, and we're seeing this more and more, is what the IRS will do is they will say audit a property manager. They will take their database of all their payments and then match them up to their records. And if they see George Dube has a rental income payment from this property manager, and that George Dube is not in the tax rolls of the United States, they'll say, hey, what's going on? And what will happen is they'll actually go back to the property manager on this 30% if they cannot collect it from George Dube. So what happens is these property managers in the United States are becoming aware of this, and they're basically saying, we need a form that says you will file a tax return every year. And these W-8 forms are becoming quite common. So you will see property managers in the U.S. asking for these forms.
Excellent, excellent. And again, we see the same in reverse on the Canadian side, and in fact dealing with one in Alberta right now, actually, for quite a similar situation. But the long and short of it is, you really do want to start things off right in the first place.
Moving forward to personal taxes. So income and expenses on the rental property are reported on a 1040 NR, which is a U.S. non-resident alien income tax return, plus any applicable state and local returns. Remember with the United States, they also have state tax returns, but they also can have local tax returns. So, for example, if you live in New York City or have property in New York City, you will technically be filing 4 tax returns: a federal, a state, a local, and a regional tax return or municipality tax return. So personal tax returns and any income tax owing is due April 15th of the following year. The Canada-U.S. Tax Treaty grants an automatic 2-month extension until June 15th, but any taxes owing are still due April 15th. The tax rates that we were talking about before, so for example, any income under $8,000, $83.75, is at 10%, going up to 35% on income over $373,000. Most of the income under $100,000, you're looking into the 20%, high 20s, 28, 29% federal tax. State income tax, depending on where you are, each state has their own tax rate, can go from 0 to 11%. 11% is Hawaii. Most states, if they do have a state income tax, are in the range of 5 to 9. Common states that do not have a state income tax are, for example, Florida, Nevada, and such. Income and expenses will also be reported on your Canadian income tax return. Now, before you worry about double taxation, you will get a foreign tax credit for any of the U.S. taxes that you paid. So it is not that you're paying double tax on this U.S. income. It's just basically the U.S. gets their first kick at the can, and you only pay the difference in Canada. So, for example, if your U.S. rate was 25% and your Canadian rate is 40%, you pay an additional 15% to Canada. Last point to make here is individuals will need a U.S. ITIN, which is a U.S. individual tax identification number. This will be required to file the personal tax return.
Peter, maybe you can comment on a scenario where I own a property in Texas. I didn't realize that I was supposed to file my tax returns. Again, I thought there wasn't that much net income, didn't get too excited about it. And it's been about 5 years since I filed the tax return. I now understand that I'm supposed to file a tax return. Should I go back and file tax returns? Should I just start now from scratch, or what would you recommend?
I would recommend going back and filing the tax returns. Yes, the IRS can deny the filing it on a net basis, but again, you can argue, not ignorance, but you can argue or make the argument that you didn't know. They tend sometimes to accept it and sometimes they don't. It really depends on what kind of auditor you get on the other side. I would recommend going back because if you start on a go-forward basis, 2 main things that happen. One, in the United States, you are required on an annual basis to take amortization, unlike Canada where you can't take amortization. Or sorry, I said that wrong, my apologies. It's a discretionary deduction. You can take amortization on the property or you don't have to. In the United States, it's required on an annual basis. So if you don't file the tax returns, they will deny any amortization, and if it's in a break-even position, this would put it in a loss position, so you don't have the loss carried forward against future taxes. The other negative problem with that is when you go to sell a property, what they will do is they will assume you have taken the amortization and reduce your cost base by the amortization you should have taken. So you can see from that you are now into a double taxation situation.
So in other words, going back and filing tax returns, while perhaps I might get into some difficulty, it's probably still much better than almost a certain difficulty of not filing those
Absolutely.
returns. Okay. So let's proceed a little bit here to a scenario where now we're going to use a corporation to invest in our U.S. properties, and this particular corporation will be a U.S. corporation as compared to a Canadian corporation.
So U.S. corporations are required to report their income and expenses on a Form 1120, which is a U.S. corporate income tax return, again, plus any state and local returns. Federal corporate tax returns are due the 15th of the 3rd month after the fiscal year. Don't know why they just couldn't make it the end of the month, but they believe in the 15th of every month. State corporate tax returns are due by the 15th of the 3rd or the 4th month after the fiscal year, and depending on the state. Federal tax rates range from 15% on income under $50,000 to 39% on income over $100,000. So in comparison to personal income tax rates, you can already see that the corporate tax rates are higher. State income taxes ranges from 3 to about 10% depending on the state that you are in.
So overall, my corporate taxes, if I'm going that corporate level, because I've decided perhaps for legal reasons that I don't want to be exposed on the personal side, I'm essentially making a much bigger trade-off potentially as compared to a Canadian investment. If I'm in the U.S., there is definitely going to be a higher tax cost should I choose to go this structure.
Correct. Now, capital gains tax. In the United States, they do have a capital gains tax. So for personal long-term capital gains, and the long-term is anything held for more than 1 year. Anything less than 1 year is just taxed at your regular rates. The federal capital gains tax rates go from 10 to 15 plus applicable state tax rates. Corporate capital gain tax rates are the same as the income tax rates. There is no difference between regular income and capital gains for a corporation. So there could be potentially significant savings if the investment is held personally. To give an example, a capital gain in the state of Florida would have 15% if it was over the certain threshold, and no state tax owned personally. So 15% would be your maximum. In a corporate tax rate for the state of Florida, you could have your high tax rate of 39% on that capital gains if it was greater than $100,000, plus a Florida state tax of, I believe, approximately 6%. So you can already see the difference between 44 and 15% personally. So there's significant savings on capital gains using a personal vehicle to hold the property.
And Peter, so in Canada, if I have a capital gain, only half of my capital gain is taxed. Is that the same in the United States?
No, it's not. It's the full capital gain.
So again, a big difference from the Canadian and the U.S. side of when we're thinking about those capital gains. So that 44% potentially on the corporate side that Peter's referring to can again be fairly expensive, particularly compared to the Canadian side of things.
Correct.
So that often we've heard of this dreaded estate tax, and it's not something that we specifically have here in Canada. However, just because we don't have one in Canada doesn't mean we should not be concerned.
The estate tax, or some people refer to it as the death tax, basically comes into play on the value of your U.S. assets at the date of your death. The maximum estate tax rate is 35%, which is actually down from 55% in 2001. So you can see that they've reduced it 20 points in the last 10 years. Non-residents are taxed on the U.S. value of their U.S. property at the date of death, not the date they purchase. So if the property has gone from $500,000 to $1 million, it would be based on that $1 million. And liabilities, under most circumstances, don't matter. The estate tax will be prorated based on the value of U.S. tax, value of the taxpayer's U.S. assets versus the value of the taxpayer's worldwide assets. For example, if 1/6 of the taxpayer's assets are in the United States, they would have to pay 1/6 of the estate tax on their death for their U.S. holdings. Typically, what we see is if the estate is set up properly, though, the estate tax may not apply until the death of the surviving spouse, so basically the second to die. And what we see some investors are planning to do is once the first spouse dies, they may then turn around and sell the property so that they don't come into the estate tax.
And now, is it possible, Peter, that if I set things up in a not quite as optimal fashion, that between my wife and I, if I, for example, own my properties and I pass away, and then at some point later she passes away, could we pay tax twice on everything?
Potentially, yes.
So again, a key factor in setting up your structure to try and ensure if you're trying to provide anything for the kids, if, for example, I'm going to be taxed at 35%, if I'm going to pass away and pay 35%, and then my wife passes away and pays 35%. By my math, that was pretty close to 70% of my assets disappearing pretty much overnight. So again, a little bit of forethought into setting that structure up is probably well worthwhile, and we haven't even spoken of the Canadian implications.
So common ownership structures that we see, again, these are not an exhaustive list. We're just going to go through 3 of the most common ones that we've seen, and we'll talk about other ones that are out there right now. But the common ones are strictly personal ownership. Using corporate ownership is the second one, and the third one is a sort of a hybrid vehicle using the limited liability partnerships. And then we'll talk about other structures in a moment. So personal ownerships. They're the simplest and easiest to set up. You've got the lower income and capital gains tax rates as compared to corporate tax rates. The main disadvantage, though, is you've got exposure to U.S. estate tax and unlimited personal legal liability.
And Peter, so again, if for whatever reason I decided to bypass the use of a corporation or another form of entity, and I decided I want to own some property personally, does it make a difference if I own it versus my wife own it, or both of us own it, or is there different ways for the 2 of us to own it?
Again, no situation will be the same. We see potential structures where you'll put multiple family members on for personal ownership. What this basically does is it spreads out the exposure to the U.S. estate tax. So if there's 4 family members on, you pass away, it's only 1/4 of the value of the property is yours. Does it matter in terms of if one person has a significant number, greater worldwide assets opposed to the other spouse? Yes, it does. As you can imagine, we were talking about the proration before. If you've got greater worldwide assets, you might want to hold the American property to reduce the estate tax, as opposed to someone who doesn't have, a spouse who doesn't have a lot of worldwide assets. That would where a 50-50 would not come into play.
So again, depending on my particular situation, there may be more or less a better way of organizing things, and maybe I shouldn't just do whatever my neighbor just did.
Absolutely. And again, personal ownership can be different and it still be personal ownership.
On to corporate ownership.
The structure we recommend for U.S. corporate ownership is that a U.S. C corporation or a regular U.S. corporation is owned 100% by a Canadian holding company. And you may ask, what's the point of the Canadian holding company? In our discussions with lawyers in the United States, they recommend the Canadian holding company as an additional buffer in terms if the veil or the corporate veil is pierced in litigation. So for example, if the corporate veil is pierced in litigation and they look and they see a numbered company holding the U.S. corporation, they may or may not sue the individuals. It's just an added level of protection. It's a very simple cost. And the other reason for the Canadian holding company, again, comes down to the estate tax. If you were to die and you just hold the U.S. C corporation personally, well, that's still a U.S. asset, and you've now exposed yourself to the U.S. estate tax. The Canadian corporation you're holding, the Canadian holding company never dies, so you never expose yourself to the U.S. estate tax.
Okay. So in other words, a corporation cannot die, but unfortunately we as individuals will at some point in the game. And so that's the end recommendation. Yep. And this corporate piercing, if you will, essentially in English, for those that didn't follow that, means that potentially the shareholders of the company could be sued despite the fact that there's a corporation in place.
And when it comes to legal liability, especially in the United States, the corporation will not protect you from negligence. So for example, you had a fire marshal come in and say, you need to fix X, Y, and Z, and you don't. You personally decide not to, they're going to come out after you personally, whether you have a corporation or not. The advantages of the corporation, as we talked about, no U.S. estate tax on death, and limited personal liability. As we talked about already, you can see the disadvantages: higher income tax, higher capital gains tax, state corporate income tax can be higher depending on the particular state, and it is more expensive to set up and run on an annual basis than personal ownership.
And this C Corp that you've spoken of, Peter, I hear a lot about an LLC. Is that the same thing in the United States?
No. An LLC is a limited liability corporation. Great vehicle for U.S. residents. You will see a whole bunch of U.S. residents own a majority of their assets through the LLCs. The unfortunate part is an LLC does not work for Canadians. If there are people out there who are recommending LLCs to Canadians, they don't work. And the reason for that is in the United States, they're a flow-through entity. So you get the corporate protection of a regular corporation, but you get the income flowing to you personally, which basically allows you to use the lower income and capital gains rates. Great setup for Americans. For Canadians, the Revenue Canada has basically said, no, this isn't a flow-through to us. This is a corporation. So what happens is you'll be paying your U.S. tax, say in 2010, you pay U.S. tax on the income. But if you don't receive a distribution from the corporation until 2012, that's when you would pay your personal tax on that income that you received in 2012. The unfortunate part of this, you also don't get to use your foreign tax credits then because they're not in the same year and it's not considered the same income. So with an LLC, you see that there's going to be double taxation. That's why we do not recommend the use of LLCs.
So basically, with that LLC, we're not able to match in terms of the source of income, the type of income, and the year involved, and therefore the tax treaty and the foreign tax credits do not work for Canadians. So at one point in time, yes, there even was, from the Canadian perspective, an ability to do that, but some of these rules are relatively recent, and the last go around with the tax treaty and court cases actually.
There was a court case, I believe, in September, TD Securities versus the Queen, that basically reaffirmed Revenue Canada's position.
And therefore, despite the fact that you and probably will see a lot of the LLCs, both from Canadians and a lot of the investing books that you'll read, they are something where that, while appear very attractive, they certainly have some strong negative repercussions to us as Canadians.
The next structure, we're starting to see significant use of this, is a limited liability partnership. The property will be owned by the LLP, and then the partners of the LLP will be a 1% general partner, typically a U.S. C corporation or an LLC. And I know I just said LLCs don't work. For a 1%, there's going to be very little income flowing through for 1%, and I pretty much can get it down to zero with some expenses, so I'm not worried about an LLC in that case. And then 99%, the limited partner, is the individual taxpayer. This is great in that you get the income and capital gains are taxed same as a personal ownership. You get limited liability to the individual owners because the general partner, or the LLC, or the C Corp, basically takes the unlimited liability, and if there's no assets in there, which there isn't, you got nice limited liability now. The disadvantage is you're still exposed to the estate tax, and there are ways around that, and it is more costly to set up and administer in comparison to personal ownership.
So in Canada, Peter, we see a lot of the LLPs more so in a syndicated environment where we're trying to get a variety of investors together and perhaps tackling a slightly larger project. Is that something that would be similar to the United States, or can I just as an individual go ahead and tackle this with the LLP?
This can be set up as an individual structure, and we're also seeing it with a lot of syndicate work.
Okay. We'd mentioned some other types of structures that were available there, and again, we hear a lot of and see a lot of trusts or land trusts, for example, that are being used. And again, maybe Peter can comment a little bit first on what are some of the implications of the trust, or is that something that we should be looking at, or just something that only is done on very rare occasions?
The trust can be a nice add-on to a lot of the limited liability partnership structure, or a cross-border trust, which is most common, can be a nice vehicle to hold a significant value of a personal property. So if you're not renting out $1 million second home, a cross-border trust is a great vehicle to hold it in. If you have a $1 million rental property in the United States or apartment building, Canadian investors may want to use a trust to hold their limited partnership holdings to help them mitigate the estate tax.
And should this trust be a Canadian trust or a United States trust? And maybe I should partly answer that from the Canadian side, and it is to say that if, for example, a U.S. trust is created and there are Canadian beneficiaries or Canadian settlers for that, which in English means a Canadian started it, or a Canadian is going to be allowed to derive some of the assets from that trust. Revenue Canada will frequently, if not in the majority of cases, consider that U.S. trust actually a Canadian trust. And now you have a real pickle because the United States considers it a U.S. trust, Canada considers it a Canadian trust. Everybody, of course, wants to tax it, and it leads to the ultimate questions of who gets to tax it and who should I pay first. And again, needless to say, both governments will have their hands out looking for some assistance that way.
The majority of the cases, this will be a Canadian trust.
So by having a Canadian trust, we're going to avoid some of those issues, and then we move on from there. Leading a little bit into the Canadian tax implications, and this again is going to be relatively brief here, and then we're going to more so open this up to some questions from the group here. And to start off with, as a general comment, Canada reserves the right to tax Canadian residents on their worldwide income. In other words, just because we invest in the United States, it doesn't mean that Revenue Canada is not interested, and hence part of the discussions, as Peter's been referring to, is foreign tax credits, foreign tax treaties, etc. So again, it opens up the avenue to that worldwide income, in turn double taxation. So the tax treaty in theory tries to help eliminate that in most cases. It's not perfect, particularly, for example, with respect to the estate tax, because there's not a similar offsetting tax in Canada, so therefore there's nothing to equalize, if you will. The last point there in terms of the progress of legislation is very, very important. As a quick little tax history lesson, from a Canadian perspective, Canada has been struggling with how exactly it should be able to enforce and tax this worldwide income, or this concept. And roughly speaking, about 12 years ago, legislation was introduced in a draft format which would give Canada some more abilities to do this foreign taxation, if you will. And as you can appreciate from a world economy perspective, every country, of course, wants to get as much as they possibly can from taxation elements to boost their own government. Canada is certainly no different. The oddity from a tax perspective is that, generally speaking, when legislation is introduced, relatively quickly, and that generally means 6 to 12 months, that legislation becomes formally accepted and is part of the Income Tax Act. The particular legislation or series of pieces of legislation from a Canadian perspective on worldwide income is actually still in draft format. And the most recent changes, or proposed changes, coming in the late summer, before that in the spring, before that in the federal budget, before that just after the last year's holidays. In other words, there's a continual cycle of, here's something we're thinking about, and we're not quite ready. Oh, we're going to think about it, we're not quite ready. The bigger problem is that much of this legislation is effective, for example, from 2007 forward. So now we have the difficulty of saying we're going to be taxed from 2007 forward with this new legislation, except we don't know what the new legislation means. So in trying to provide advice to people, you can appreciate the difficulty of being able to provide said advice when you don't know what the rules are. And one of the general concepts, what Canada's trying to do, is say that, okay, we don't always know in these foreign countries whether or not we have a good idea of whether their accounting practices are somewhat similar to ours, or whether there's hidden assets, for example. So what we're going to do is potentially tax Canadians on what we consider the value of the investments to be. And we will approximate the taxes and the income they otherwise would have. And that's going to be done by setting a set percentage. In other words, if somebody has or is deemed to have $100,000 of value, they may be taxed. And again, there's different opinions to what this rate may end up being. At one point, it was going to be 6%, for example. And so on an annual basis, there would be a 6% tax regardless of the amount of income that was made. Questionable whether that's ever going to be implemented, but the long and short of it is to say, from a Canadian perspective, we cannot always provide accurate advice as to exactly how that's going to be taxed because legislation hasn't been created yet, which obviously puts us in that pickle we just discussed. Another point to the investing, which doesn't per se trigger taxes from the Canadian side, is it's very, very important to identify to Revenue Canada that there are foreign assets that are generating income. Failure to do so certainly gets Revenue Canada's attention. They're not very pleased with that. There are some significant fines for failing to disclose those assets and the related income from it. So even if you don't know all the details to it, it's important to make a little bit of disclosure. There's required forms that are completed on an annual basis. And basically it's kind of, for lack of a better word, a little bit of a get-out-of-jail-free card, just to say, hey, here we are. There's nothing to worry about, Revenue Canada, but we'll certainly be thinking about you in the future should we make some money. So even if you're not making money, it's important to disclose in that capacity. I think we're kind of ended off from there, but maybe we'll ask Peter then again, going back. So ultimately, maybe Peter, actually, I'm going to back off on that and say, based on your experience, what would you suggest are the three largest mistakes that Canadians can make investing in the United States?
I'd say the three biggest mistakes we've seen for our clients or people that come to us, the use of LLCs was a very popular strategy a number of years ago, and even today you still see people recommending the LLCs. We do not recommend the LLCs for the reasons we talked about before. The second biggest one is not filing the tax returns. I know that people will say it's not a big deal, it's not a lot of income, but remember with the United States now, they are heavily in debt, and it's very difficult to raise the tax rates of your own residents. For the people who vote you into power, if you raise their taxes, they will tend to vote you out of power very quickly. So the last 2 years, the Internal Revenue Service has been actually doing a pilot project on non-residents. And in all likelihood, we are going to see significant audits now for non-residents. We are going to see significant challenges to non-residents. And as I say to clients, it's really easy to tax people who have no vote. If you need more money, that's a great place to get it. The third area we see a lot of people do is setting up the structure wrong to begin with. Make sure you need the structure is correct for you at the time of setup. Get the right advice. Consult with a cross-border accountant and or lawyer, and move forward from there.
Excellent, excellent. Madeline, I don't know if you want to put some comments in terms of what your experiences to date have been.
Yeah, that was a great presentation, guys. Thank you so much. That was so informative, and I guess there's so much to know, as you guys can see, that that's why I just have these guys take care of it for me, so that I don't have to know all of it. So they've become a really, really important part of our team. So thanks a lot for taking the time. And I don't know, Jarek, do you have people that have questions that they would like to ask George and Peter?
Definitely. There will be a question about that subject. So first of all, Angie, are you ready to take over the question? You are unmuted.
Yes, I am. Thank you very much. Peter and George, my question is, if we already have a U.S. corporation set up, what assistance can your firm give us regarding taxes and corporate accounting management?
So, was it Amy, I believe?
Angie.
Angie, my apologies. Angie, we have a number of clients who are in a similar situation with you where they have a U.S. corporation. As a U.S. CPA, I can take care of your corporate filings, your state filings. We can do the bookkeeping and accounting for your U.S. corporation. We can and then we will also take care of your, if it's held personally or held through a Canadian holding company, filing the Canadian returns that go with that.
Essentially,
Excellent.
we can handle the whole shooting match on that side.
Good, thank you.
Thank you.
You're most welcome. Ian, you're next online. Please just allow me to unmute you. Ian, you're online.
Hey, can you hear me okay?
Can you speak louder, please?
I will try. I'm not sure if you can hear me, but I'm actually right in the process almost this week or perhaps next week in setting up the structure to invest in the US, so thank you very much for taking my question. What I was thinking of was having a Canadian corporation own a C Corp that owns multiple LLCs that own the property, and then having the LLC or the C Corp employ me in Canada as a manager, as an employee, and that way they could pay me, or as a contractor they could remit funds back to me in Canada as an employee. The LLC would allow funds to flow through to the C Corp. The C Corp would stop any funds flowing straight to Canada, and everything remains in the US apart from any funds that I then charge as a manager. Any particular comments?
And I'm sorry, you're breaking up, Ian. I couldn't fully hear. So you've got multiple LLCs owned by a U.S. corporation? Is that correct?
That's what I'm about to set up, or I was thinking of setting up. And the C Corp is owned by a Canadian corporation. And then I was thinking of having the C Corp in the US employ me in Canada as an individual, as a manager, and that way I can charge the C Corp fees for services rendered.
Okay. What kind of investments are you having? Is it just, it's all real estate in the United States?
Real estate, yeah.
Now, I don't see the major advantages of the multiple LLCs. Is that instead of just setting up a C Corp to hold each of the properties, is that the main reason?
My thought process was that if I had, say, 20 properties in the US, I wouldn't have more than maybe 4 or 5 properties in any one LLC in case it was attacked for any reason, and that way there would be less place to go, or I wouldn't lose.
No, I understand that structure. I would just almost, if that was an issue, I might put 2 or 3 in a C Corp and move forward from there and not use the LLCs.
Okay, but then if the C Corp earns income, it would automatically, would it not then become part of Canadian because the Canadian Corp owns the LLC?
No, it wouldn't. It wouldn't be Canadian income because the C Corp is not a flow-through. So it would not be taxable here in Canada until dividends were paid to the Canadian corporation. So you'd basically be paying just the U.S. tax until you brought money back to Canada. Now, as an employee, you'd get the deduction in the C Corp and then have to pay taxes in Canada. The caution I have for that is, as an employee, are you also taxable in the United States? And there's a thing personally, and you may or may not be. And you need to look at the tax treaty to determine, based on dependent personal services paragraphs in the tax treaty. This is fairly complicated. I would suggest you want to look at it before finalizing your structure.
Thank you. I appreciate the time.
Ian, you are muted, and I guess that would be a good idea to get the telephone number from Mr. George and Paul and contact them directly over the phone. That's just idea, right? So if you see the number here on the screen.
Is that what you guys prefer, how to be contacted then, George?
Yeah, either by phone or email. Great.
If you go on our website, you can get all of our contact information.
Okay.
Perfect.
Great.
Mr. Randy, you are next online. No, there is a lot of Randys here today, so. Mr. Randy, you are online. Mr.
I think my question. Yep. Okay.
Go ahead. Mr. Randy, you're online.
Yes, I think you hear me? Can you hear me?
Yes, we can hear you.
Oh, now we can. Yep.
You can hear me? Okay.
Yeah,
I was going to say, I think my questions have largely been answered by the previous gentleman. One thing, though, if I'm a U.S. citizen and I want to use LLCs, does that change the game?
Absolutely.
Does it make those more viable?
It can make it more viable. Remember, if you're a U.S. citizen, you have to file a U.S. tax return every year. You probably know that. If you're in the U.S., I would still not recommend the LLC if you were a Canadian resident taxpayer. So if you're living in Canada and a resident in Canada, don't use the LLC. But if you're a U.S. citizen living in the U.S., LLC.
Okay. All right. Yeah, I know I'm a resident, so I just curious how to get that flow through in the protection.
That's why the LLP really is a nice. It's very similar to what the LLC structures are, but for some strange reason, Revenue Canada likes the LLPs instead of the LLCs.
And just to clarify, so you have a limited liability partnership that also has a general partnership at 1%, and then a partnership with a C Corp or something like that at 99%?
No. The C Corp or an LLC would be the general 1% partner. The 99% would be the individually.
General idea was that
gotcha.
That's going to be the target of the lawsuits, if you will, or you're going to absorb the lawsuit in theory.
Okay. Thank you for clarifying that, and thank you for answering the questions.
No problem.
Okay, Mr. Randy, you're muted. Madeleine, can you read the question from Shell, please?
Let me see here. Okay. Okay, I've been doing joint venture partnerships as a U.S. citizen owning a U.S. corp that owns a U.S. LLC. The joint venture partner owns a percentage of my LLC with a Canadian holdings company. Based on your comments, is this incorrect?
So we have a U.S. LLC owned by a Canadian holding company?
Yeah, do you want me to read it once more?
That's fine. So if we have a U.S. LLC owned by a Canadian holding company, what happens is the LLC is a flow-through in the U.S., so you'd have the Canadian corporation would have to pay U.S. tax on the income that flows through to it, but it would not be reported in Canada, so I don't like that structure. It's very similar to the personal structure.
It's basically saying the joint venture partner owns a percentage of his LLC with a Canadian holding company.
Yeah, I'm not a fan of it.
Okay.
Okay, next one will be Mr. Don. Mr. Don, I'm just going to unmute you very shortly. Please allow me to find you. Mr. Don. Hello, Mr. Don. Hello? Okay, it looks like Mr. Don's mic is not working. So the way how Mr. Don, I would like you to do it is please type the question and then it will be answered, okay? Mr. Richard, you are next. Mr. Richard, you're online, please.
Thanks, I'm ready here. Great presentation. Thank you, gentlemen, and thank you, Madeline, for arranging this. Question for someone starting out, as you outline all of this stuff, it seems like there's, it's very complicated and complex, especially on an ongoing basis, and it would be horrible to have all of the profits that are used if you bought a couple of U.S. properties to have to pay the accountants. I mean, we've got to pay enough to the tax man if there's no actual profit at the end of the day left. So I guess really my question is, what would you recommend as the least expensive structure for the individual who was just starting out and just wanted to get going?
So least expensive is easiest. That's going to be an easy question. Own it personally. If the expense is the major issue, own it personally. It'll be your cheapest.
The thing to watch out there for, and again, I have a slightly different opinion in the sense that I love seeing the accounting bills higher, obviously. But for those that are, for whatever reasons, not quite as keen on that concept, one thing that we do see is that people kind of get enamored to a high percentage return. For example, they're going to make 50% return. They've got a $10,000 profit, and they think that's wonderful, and yada, yada, yada. And I'm not trying to say having a $10,000 profit is not wonderful, etc. And in all seriousness, the question's absolutely right. I mean, you can't pay a fortune for accounting, legal fees, this, that, and the other thing, and compliance costs if there's a minimal profit involved. But on the same token, I think in times you have to look at the nature of the investment to see whether or not it was really worthwhile conducting that investment despite that percentage return, perhaps. Maybe it's just not a big enough project to make it worthwhile in the first place.
And the other thing we also see is, yeah, maybe the first one's owned personally, but if the plan is to own multiples, you might want to spend the additional money up front to make sure that you've got a proper structure up front if you're planning to buy 5, 10, 15, whatever the number is over the next X number of years.
Can I just simplify this question a little bit, guys? What about, okay, so just for instance, the property that we just sold to a Canadian investor here a couple weeks ago.
Yep.
She just sent her funds into the title company and purchased the property. She didn't open up a corporation or anything like that.
Yeah, she just owned it personally, correct?
Yes. And that was the best way for her to do it, right? Because she's just planning on buying a couple properties.
Structure for her.
Yeah. And people, again, unfortunately, they have trade-offs, and based on the U.S. scenarios, it becomes a little bit more sharply contrasted in the sense of, in often cases, as Peter pointed out, that personal ownership can be superior from a tax perspective, particularly where it's a little bit of a shorter period of ownership, we're in good health, we're younger, etc. But we are opening or exposing ourselves to some of the litigation issues. And is it going to be definite that we'll have a litigation issue? Obviously not. To some degree, it's fear-mongering. But then part of the question is going to go back to whether we want to be the poster boy and girl for would have, should have, and could have.
I guess to just unpackage my question a little bit more, maybe you can make a recommendation. Like, where's the line, I guess, is kind of what I'm thinking. If I say I'm going to own 3 properties, then that's fine to do it personally. But if it's more than 5, then I should set up the structure. Or is there a certain amount of cash flow that we could use as a benchmark, as a measuring point? I'm trying to think, all of the tax rates plus the accountant's bill, where is that threshold of benefit to spend all the extra money on setting up all the corporations?
Sure. So I would say that where you see a corporation being used more often than, say, personal ownership is really 2 cases. One, large dollar properties. So you can own 3, but what happens if they're $1 million each? And you're not in good health, you're an older gentleman or lady, the estate tax comes into play a lot more than if you're, say, in very good health and 35. But the other place where a corporation comes into play is the use of the fund. You see a lot of our investors who have money in their Canadian corporation. If they want to own it personally, they're going to get taxed on pulling that money out for the down payment. So sometimes the time value of money, if you're going to be holding these properties a long term, the corporate structure makes sense if you're pulling money out of a Canadian corporation, because you're not going to be taxed on pulling that money out personally. In terms of a line, it really does depend on everyone's situation is different. Because the 3 properties could be great if they're $50,000 each. Yeah, not a huge issue there. If they're $300,000 each, I would say that maybe the limited liability structure might make more sense as opposed to the personal ownership. Again, and it also goes to your risk tolerance as well.
I think, too, and a lot of this stuff, obviously, that Peter and I have been referring to, clearly it sounds complex, and we're trying to show different options. And often our clients, when we have the ability to sit down with them over the phone or in person to talk about what's going on, after about an hour, it's fairly clear in most cases what an optimal structure is going to be. And in many cases, those costs involved are, I'm not trying to say that there's not a dollar figure involved, but it's not necessarily significantly more than what a similar structure in Canada would be. Correct. Although it may sound more complex.
Thank you.
Did you get an answer, Mr. Richard?
Yes, I think that was that's fine, and it makes sense that it's you got to pick that dollar value, right? If you're saying if it's $50,000, then 3 or 4 or 5 properties maybe before you set up your corporation's structures. But if it's a if it's an apartment building, certainly you'd want to have the structures properly set up in place.
Absolutely.
That's great. Thank you.
You're most welcome. Mr. Richard, you're muted. Madeleine, there is a follow-up question with Mr. Sean about the joint venture. Would you mind just reading that?
Sure. Okay, let's see. Is this a LLP instead of LLC? Oh, okay. What is the correct structure with my situation? LLP instead of LLC? It's a follow-up question from Sean.
I would say yes. I don't like the LLC structure at all.
Okay.
Okay. Next question, Mr. Don. Yes, Myrna. Don, you are unmuted.
Okay. Okay. And I do have a holding corporation in Canada, and I'm doing like some e-commerce in the U.S. Now I have applied for a merchant account, and they have recommended or suggested that I get an LLC in the U.S. Now, I have talked to an accountant in Florida, and he suggested that I get an LLC for the e-commerce, and then later on when I want to invest in real estate, that I open up another LLC, more or less attached to the first LLC. And how would you recommend that be set up? Is that a right way of doing it, or that's something?
Again, going back to the LLCs, I would not recommend an LLC for you in your case for your e-commerce. Americans will recommend LLCs probably 99% of the time, or at least a good 80% of the time. So your U.S. accountant will recommend an LLC because he thinks it should work in Canada as well. It doesn't.
Okay.
So there's potential structures there. You might want to set up a U.S. corp. You might want to just run it through your Canadian corporation and have your Canadian corporation file a U.S. branch tax return. There are a whole bunch of different structures that we can talk about later on that one. It really depends on size, depends on a whole bunch of different things there.
Peter, can I interrupt you now? Sorry.
And the other thing with e-commerce is it's probably one of the hardest ones to determine if you have a permanent establishment. Under the Canada-U.S. tax treaty, a Canadian person or corporation is taxed in the United States on business profits if they have doing business with a permanent establishment in the United States. E-commerce is one of those tricky ones because where are the servers? Where's the mind in management? Where are the salespeople? There's all that kind of stuff. It's very difficult to determine if you have a permanent establishment in the U.S. That's something I would almost suggest we need to sit down for an hour or two to talk about and move forward.
Okay.
Sure.
Can I ask you a question as well there, Peter? When we talked about my structure for our multifamily in Texas, of course we were going forward with the LLP structure, but the cost of it was $5,000 to $10,000 or something. Is that just because of the contracts and everything that need to be done because we're bringing in joint venture partners and all of that? Like, is an LLP normally that expensive, or is that just because of the structure?
Normally, I would say yours was definitely more expensive because of all the investors that you were bringing in.
And the legal fees and all that, I guess.
Structure, where the fees add up is that it's not so much the legal fees. Setting up corporations and LLPs, and you have to register them, and it can be $2,000 to $3,000 just to register your corporation and your LLP in the United States. That's not a legal fee issue. That's just each state has their own registration fee.
Okay.
And then,
but they could do it much cheaper than I'm doing it with because of my structure, though.
Not real. I would say you're looking at a minimum of about $5,000.
Okay.
Or 4 to 5 once you got all your registration and your legal fees to set it up.
In terms of a more advanced structure as compared to a simpler structure. So you can still do a simple corporate structure for much less than that.
Sure.
Right.
Okay, so we still having Mr. Don online. Was your question answered?
Oh, yes. I just because of the complexity of the issue, maybe the best is if I give you a call. George and I can going into the whole situation in a lot more in depth. Maybe that would be the best, eh?
That sounds great.
Okay, I'll do that. Okay, thank you so much.
Thank you.
Thank you. Look forward to talking to you.
Okay, you're muted, Mr. Yan. Again, you're online.
Okay, I just have one quick follow-up question. I wondered if you owned real estate in the U.S. in an LLP or an LLC, whether you could sell shares to somebody who wanted to buy the property from you. So if you had an LLC, for example, that owned a house, and you were to sell the shares of the LLC, whether the tax treatment from a capital gains perspective will be the same, or whether you're just selling shares.
So, for example, if the LLC or LLP still owns the property and you shall sell a percentage of your shares in that LLC or percentage of your partnership units in the LLP, there would be a capital gain based on the value of those shares or units when you bought them and for what you sold them. So the difference would be a capital gain.
Okay, so there really wouldn't be any benefit to selling the shares or selling the property. It would be roughly treated the same.
Sometimes you may see that just for simplicity. If you want to bring in another investor instead of having to put them on title, you can sell your units in the LLP.
Okay, thank you.
Perfect, you are muted. And then, Angie, you're online.
Surprise, Angie had to run away, and it's her husband, Terry.
Okay.
And my question...
Here we go.
Sound like Angie.
Well, you can call me Angie if you would like. I won't be offended. I'll know who I'm being called anyhow. So my first question is regarding the presentation, and this obviously contains very valuable information, and we know many people who would benefit from it. And we're wondering if it will be rebroadcast or if there will be a recording that people will be able to access.
I would like to answer that question if you don't mind. Yes. We are recording all the webinars on a regular basis, and they are posted on CanadaREIC.com, Canada Real Estate Investors Club, in the specific section. Secondly, you will have redirections, and we will post on multiple medias like iTunes, Bot TV, and any other. So please don't worry about that. Visit canadareic.com and you will have all the information. Takes approximately 24 hours.
Perfect. I really appreciate that. The second question I have is regarding JVs and loans. Now, and just in terms of how to set some of these things up, we have people who are in Canada. We've got some things set up in the States, but we have people in Canada who have an interest in investing either with us or through us. Can you talk a little bit about how tax withholding laws have changed regarding lending money across the border, and possibly also in terms of some strategies or structures? We would have things set up. Would we require other people to set up the same kind of thing in order to JV strictly in the States, or can we JV with a Canadian corporation? Can you talk about that? Thank you.
Not a problem. So there are two questions. The simple one on interest. With the new Canada-U.S. tax treaty that's been ratified in the last year, a couple years ago. Thanks, George. There is no withholding on interest. It used to be 10%. So now if you have a loan to a U.S. company, a U.S. individual, or a mortgage, and you're charging interest, there's no withholding tax.
Great.
The second part, in terms of investors, the LLP structure is maybe advantageous to you in that the limited partners would be, you could have multiple partners in that LLP. It doesn't have to be the individual. Madeline has this set up for her Texas investments. That would be one recommendation. The other recommendation can be a C Corp, and where those C Corps really come into play is if you have a significant number of investors. If you've got 50, 60, 70, 100 investors, a C Corp, I know you're paying the additional tax, but how much legal and accounting bills are you paying if everybody has to file a U.S. tax return? Whereas
Right.
So that's where, those are usually the two areas that we see, is the LLP or the corporate structure that are the most commonly used.
If I can throw in a comment there too, perhaps where partly you were going with the question, we don't see the joint ventures used in the United States nearly to the same outline or degree that we use them in Canada, just based on a variety of different tax rules. Okay. So in Canada, it's much more flexible and easier to do it that fashion, whereas in the United States, we have to play a little bit of a different game there.
In speaking with a U.S. lawyer recently, she does not like joint ventures. She says, if you're going to do that, do a partnership. It was her recommendation, because the U.S. doesn't really have joint venture laws.
Okay, good. Well, that helps a lot, and thank you for taking that question. And Angie and I will be calling you guys for a consult regarding this.
Thank you.
So much.
Our pleasure.
Okay, so husband of Angie, you are muted. Okay, Mr. Brian Minsky, he has a question. Madeline, would you mind just reading, please?
Sure. Okay, so Brian's asking, from the point of view of taxation and structure, which state, generally speaking, is the best to invest in?
Okay. That's a very difficult question, because in terms of state tax rates, they're all relatively the same. There are some states with none. Alaska has no state tax. Florida has no personal state tax. Nevada, with all their gambling income, has no state tax. South Dakota, Texas, Washington, and I believe Wyoming as well. So from a state tax, those are probably your cheapest. Certain states are going to be more expensive. New York, California. California is one of the most expensive states in terms of tax, but it's also one of the most expensive states in terms of compliance issues. They have the most complicated tax returns in California. And there is significant debt in California now, so the rates aren't going down. In terms of investments, we don't really recommend. We're not going to recommend what state to invest in, because if you find a good property in Nevada or a good property in Texas or even a good property, heaven forbid, in Detroit, as long as the investment makes sense, you go forward from there.
We're trying not to get into, per se, the investment advice on that side of things. And,
Thanks for that, guys, since I do have investments in Detroit.
So do I.
Red Wings.
So there's a follow-up question from Mr. Brian. Madeline, could you just read it, please?
Okay, let's see. Should one invest in a state and set up a structure in a different state? For example, invest in Florida, however set up structure in Nevada.
If you're going to be setting up a structure in Nevada or in, the other common one is Delaware, and this usually comes in with corporations. Delaware and Nevada have very robust and very good corporate tax laws. So when you set up, majority of U.S. companies are set up either as a Delaware or a Nevada corporation. And I would say of that, Delaware is a lot more than Nevada. So yes, you would set up your corporation in Delaware or Nevada, and then you do your place of business in Florida. That's not a problem. You'd have to file a Florida tax return to report the income that was earned in Florida for a corporation. And you would also have to do your annual filings, which has a minimal cost, depending on the state, of a few $100s, to Nevada or to Delaware. But you would not have to file a Nevada or Delaware tax return if you were not working in, if you're not earning any income from that state.
Okay.
Okay, I guess there's no more questions. So, Madeline, in your hands, please.
Okay. Well, guys, I so much appreciate you coming on today and giving us all this advice. It's awesome. I also wanted to mention to you guys that I'm located in Calgary, Alberta. Dube and Associates is located in Toronto. But as I said before, they do all of the accounting for all of my 10 corporations. And it's never been an issue or a problem with us being located in different provinces. So I just wanted to let you know that as well. Also, just wanted to tell you a little bit about what we're doing and where we might be able to help you with your U.S. investments. When I began my expansion into the U.S., which was a little over a year ago, I met one of my partners, who's Patrick Gergen, in Vegas at Around the Grand Commercial Boot Camp. And well, I guess Patrick, he was analyzing the deals for Ron. Probably a lot of you are familiar with him. And after we had several meetings, we decided it would be a good combination for us to work together. So for me, it was really key that I had great partners in the U.S. that really knew that market, because otherwise, where do you start out there, right? Patrick was already partnered with Justin Hanna and Howard Connor. They own a corporation called Oasis REO. And so we all joined a partnership together. And when we first started our expansion into the U.S., we bought a whole bunch of large bulk foreclosure product from the banks. And the plan was to repackage them into smaller packages of 5 houses and then sell them to Canadian investors in packs of 5. Problem was, what I learned through that process is that the Canadian investors needed something more turnkey. You know, something that everything's already set up. We've done the renovations. We've occupied the property with a tenant. We have management in place. All of this because for them just to take 5 houses and, you know, go do renovations and different things on them in a state in the U.S. was much too difficult to do. So so we tried to make everything as turnkey as possible. We help with. I have quite a large team out there now that will help with anything that's needed. So now that's what we're doing. It's properties that are already performing, and we're providing them to Canadian investors. With the prices come between $30,000 to $40,000 a house. So we can also get you properties if you want certain ones in certain areas. You know, some people will specifically request you know, a house that they want in Florida or something like that. We can also find the product. Then we expanded into multifamily in Texas. And the more research I did, the more I liked that market. So I went out there in September and met up there with my partners, and we went through Houston and Dallas, and we walked the properties and really discovered that market. And at that time, we brought on 2 more partners that own large management companies and own properties themselves that are on the ground in Texas and have been for years and years. So they really know the market. They can bring the product to us. And so we're purchasing only significantly undervalued properties, multifamily, in foreclosure from the banks out there. Our investors put cash in, so do we. We restabilize the property and then refinance it through Fannie Mae, which is the U.S., the regular financing channels out there. And then we pay back our investors their original investment within 1 year. But you still keep your ownership in the property. We oversee everything between my partners and I. We're out there on a weekly basis, but we do, like I said, have 2 partners on the ground there that are managing their properties, stabilized at 97% occupancy. So very confident in their abilities. And that one is a minimum investment of $100,000. I guess when I looked at the numbers out there and I saw that we could pick up good properties at $12,000 to $20,000 a door, get $500 to $600 for a 2-bedroom suite for rent in Texas, versus here in Calgary, I put 3 properties under contract last summer, 3 multifamily. When we started doing the due diligence, there was no possible way we could cash flow them. So we're looking at $125, $150 a door with rents around $850 to $900. So the numbers didn't make sense based on the prices that we could pick them up in Texas, being a very strong market out there. And if you want to check out just a little bit about it, you can check out. There's one website. It's called www.texaplex.com. It's just a short video. It's like 7 minutes long, and it tells you about what's all happening with job growth and everything out there. So anyways, it was just our research led us, to see that we could gain great cash flow actually in Texas, and that it was time to start moving some money down south. So anyways, if you want any more info on any of this type of investments, or if you just want to be added to my email list, I send out newsletters every few weeks just with what we're doing out there, what opportunities there might be. You can email me, and my email address is VIA. It's V as in Victor, E as in Edward, A as in Apple, so VIA at shaw.ca. I also have a website, VIA Group, VEA Group.ca. Or if you'd like to meet, go for coffee or something, feel free to call me directly. My cell number is 403-471-4337. And again, it's Madeline. And we really appreciate you guys taking the time to come on and listen to our presentation tonight. And I know everybody's got very busy schedules, so it's not easy to fit these things in. And Yarek, thank you so much for having us. And we really appreciate it. And we hope that it's helped. And you guys have made some contacts that'll help you into the future.
Definitely, you're more than welcome. Providing valuable information for real estate investors, Canadian real estate investors, how to invest in the United States is very, very important. Please, gentlemen and ladies and gentlemen, don't make so many mistakes. Every day I've been asked how to invest in the United States, and that's perfectly fine to ask those questions. So, Madeleine, I would like to also add that she's a proud member of Canada Real Estate Investors Club, and her guest speakers, Mr. Paul and Mr. George, they were doing presentations from Toronto. I would like to thank you very much for that. Mr. Paul, would you mind just putting back your contact information for the rest of the attendees to see how they can contact you?
Sure. And sorry, Yarek, it's actually Peter.
Peter. Well,
yeah.
I put out, sorry about that. However,
Peter and George.
Mr. Peter, I do really apologize. That means you will remember till the end of your life. Okay, so is there any other questions? The goal is to have a webinar which all the questions will be answered. So please, last chance to have any questions. Mr. Richard asked, what is the website? Again, which website, Mr. Richard? I'm going to unmute you if you don't mind.
Is he referring to my website, or?
I don't know.
Yeah, Madeline, you mentioned a website in the U.S. to highlight your Texas properties. You went too fast there.
That's Oasis, REO, so REO.
Yep.
.com.
And then there was also a Texas Plus or something?
Oh, yes, the video. It's a 7-minute video, and it's Texaplex, so TEXAPLEX.ca. We do have one project we're raising funds for right now. It's a 158-unit building in Dallas. Great returns. You get your money back within a year. You still own 65%. The equity partners own 65% of the building, and yeah, it's a great deal. If you want me to send, I can send you a bunch of information on it if you're interested in that.
That's great. Thank you.
Just email me. Yeah, great. Thank you.
Okay, Mr. Richard, you are muted. And just to follow up for the organizational skills is, all that will be recorded, posted on canadareic.com, and follow-up information, follow-up website addresses, contact information, and everything will be posted as long as I will receive the information from Medline. Okay, so I think we are finished for today. Thank you very much.
Great.
Thank you. It's been a privilege speaking with everybody, and again, if there's other questions or whatnot, we're happy to field some emails and whatnot, and Peter and I did appreciate the opportunity to talk with everybody, and again, thank you, Yart, and Madeline for the opportunity.
You're most welcome, and hopefully we will have a future webinars with you guys.
Sounds great.
That'd be great.
Perfect. Thank you.
Okay. Thanks, everybody. Okay. Okay. Good night.